This is an update to my global winners portfolio, which looks across 5 different groups of exchange-traded funds to find the best performers. This month, we find that the real safe havens against the market turmoil have been primarily in 2 sectors, and we have a new winner at the country level. But generally, these market momentum strategies are a good way of keeping abreast with what's going on in markets and to think about the drivers behind those changes. Now, if you do want to keep track of what I've done to the portfolio, you can do that on stockcar.io, which is also sponsoring this video. So let's look at my global winners portfolio in a bit more detail. If you look at the factors which are driving the market turmoil at the moment, I'd say inflation is probably the most important one. And if you look at the components of US inflation, which you can see beside me here, energy is the biggest upward driver. In fact, if you look at any of these components, you'll see they're very large. For example, fuel oil is up by over 106% year on year, and gasoline is up by just under 50% year on year. And some of these year on year price rises are the largest there's ever been, such as fuel oil combined with other fuel prices. And that's the highest annual increase going back to before the 1950s. Now you might be thinking, when will these price rises year on year start to slow down? And the answer might be not anytime soon, certainly according to this article by Javier Blas from Bloomberg. And he gives 3 reasons for that. The first one is that demand for oil remains high, with an additional 1 to 2 million barrels in demand through the course of this year compared to last year. Secondly, supply from Russia is lower than it was last year, of course, because of its invasion of Ukraine and embargoes. And in fact, that supply from Russia may fall further. Now, other countries may not be able to pick up the slack, so that'll mean supply remains constrained. And even once you've pumped oil out of the ground, it then has to be refined. And there's a lack of refining infrastructure in the United States and elsewhere, and that means that the end products remain very expensive, even relative to elevated crude oil prices. So for example, if you look at the 3-2-1 crack spread, which is a measure of how much extra you pay for the refined products of crude compared to the crude oil itself, that's gone up 6-fold. So all of these factors suggest that oil prices will remain high for some time to come. So what funds do we consider for our portfolio? Well, the momentum strategy draws on 44 possible countries. These are single country ETFs, but also 18 factor funds. So these would look at things like value and momentum. We also consider 11 sectors. These are US equity sectors. We have 8 potential commodity funds to choose from. And finally, we have 9 bond funds, which we could include in our portfolio. And our momentum strategy is simply a way of choosing one fund from each of these 5 groups, which goes into the final portfolio. And the way we choose it is to look back over a 180-day period to see which fund has the greatest momentum or the greatest price increase. If none of the funds has a positive momentum, in other words, everything fell within one group, then we simply omit it from the overall portfolio. If we look at the performance of the portfolio, and what we're doing here is to compare it with the S&P 500, or at least the S&P tracker SPY, you can see that it's beaten the S&P 500 since 2004 if we backtest the strategy. And recently there's a bigger divergence between the two as it's tilted towards sectors, but also funds in commodities, which have done better during this big sell-off. If we look at the drawdown in the strategy, which is how much it's fallen since its previous all-time high, so that's what you can see in this top panel, you can see that, for example, in 2008, it lost a little bit less than the S&P 500. So it lost around 30%, whereas the S&P 500 lost over 50%. And more recently, as we've already seen, the recent drawdown really hasn't had much of an effect on the portfolio, whereas it is certainly having an effect on the S&P 500, which is now in a bear market. It's down by over 20%. Now let's look back over the previous month. So here were our 4 fund choices and also the S&P 500 over the last month. And you can see the portfolio's done pretty well, particularly our commodity choice, which is up by 12% over that month, but also the Energy Select Spider Fund, which is XLE. That's up by 4% over the previous month, which has been a pretty awful month for US equity in general. So the S&P is down 7% over the same period. Another one of our choices which did well, which beat the S&P, is the Vanguard High Dividend Yield ETF, because income and value as a strategy has done particularly well recently, certainly since the beginning of this year. The only choice which we made which underperformed the S&P 500 was our country choice, which was Qatar, because of its high energy exposure, but that didn't stop it from selling off by over 9%, so a worse performance than the S&P. Another way to look at this is, what if we'd had perfect foresight a month ago? Which funds would we have chosen, which performed best? Well, it turned out that DBE was the best performer. At the country level, China was actually the best performer. That was up by over 6%. That's considerably better than the S&P, which fell by 7%. And we didn't have any bond funds which we included last month because none of them had a positive return. But SHY, which is the short duration government bond fund, actually fell the least. And among the factor funds, the best performer, which also had a negative return, was IWN, which is the Russell 2000 Value ETF. So value as a strategy has performed very well this year, and that seems to be ongoing. Now, if you want to track my portfolio, you can do it on stockcard.io. This is what the homepage looks like, and you can just search for the word Ramin in the search bar. I'm the only one. And you can see Ramin's global winners, and you can see how much the portfolio has gained and how much it's beaten the S&P 500. But you can also filter in this box to see what changes I've made, say, over the last week. So for example, I've sold my Qatar fund and I've replaced it with MSCI Indonesia, and I've also sold my high dividend yield ETF as the momentum went negative. Now you can track my portfolio free of charge, and if you want to be notified of any changes, just click on this bell in the top right hand panel. So you can track our portfolio and use all the basic functions of StockCard free of charge. But if you do choose to upgrade to the VIP subscription, so you get all the whistles and bells, you get a special discount if you use our promo code, which is PensionCraft with no spaces, the name of our channel. And if you want to learn more about that, there'll be a link and the promo code in the description of this video. Now let's look at the country allocation for this month. Over the 180-day look-back period, which we use for the momentum strategy, you can see that Indonesia actually comes out on top, and the ticker for that ETF is EIDO. Qatar, which is our fund from the previous month, has now slipped into third place. But you can see that energy producers are still many of the top performers amongst all the different countries. And if we look at the 3 best and 3 worst performing countries over the 180-day look-back period, you can see that Indonesia is only a little bit higher than United Arab Emirates, UAE, and Qatar, which was our choice for last month. Now, of course, the Indonesian market is a tiny one, and in fact, if you look at the market cap of the entire MSCI Indonesia IMI index, which is tracked by that ETF, and compare its market cap with single stocks in the Nasdaq 100, this is where it would fall. So in fact, it would rank about number 16 if it was part of the Nasdaq, the entire country would. And it would come between Intel and Qualcomm. So certainly a tiny market. And if we use StockCard to actually find the sector exposure, you can see that it has a very large sector exposure to financial services. That's actually pretty common in some emerging market countries. Now, because it exports a lot of palm oil, but also coconut oil, and also lots of coal, you can see the second biggest sector exposure that you get is for basic materials. The portfolio is also fairly concentrated, with 71% of the allocation falling in the 10 largest stocks, with a huge allocation to Bank Central Asia, but also Bank Rakyat Indonesia. But you can also see some things like telecom companies and this gold and copper mining company, which is Merdeka Copper Gold. Our factor choice for this month is not to include a factor because all of the factors have fallen together. The best performing factor from last month, which is VYM, is also negative for the previous 180-day look-back period. If we look at the actual return, you can see that it's not hugely negative. It's only down by about 2% over the look-back period. But the rules are that if it's negative, if everything's negative, we won't include anything. So no factor for this month. Our sector choice is the same as it was last month, and that's because energy, the energy sector in the United States, XLE, has simply performed by far the best of all other sectors. Now, during the recent sharp equity tumble, XLE has certainly fallen, but it's still way above the rest of the pack over the last 180 days. So that remains our choice for the following month. Now, last month, when we looked at the dividend yield of various sectors in the United States, energy was actually out on top. That's no longer the case. In fact, real estate offers a higher dividend yield. This is taking the last 12 months of payouts divided by the price of the fund today. And utilities is also paying a higher dividend currently than energy. But still, you can see that it's one of the top 3 paying sectors in the United States. And that style of high dividend payouts has been a good one so far this year. Our commodity choice is also the same, so you can see DBE continues to be by far the best performer amongst commodity funds. And that really hasn't faltered much even in the recent sell-off. So DBE is also our choice for the months to come. And amongst bond funds, we've had another month where over the previous 180 days, all of the funds had a negative return. It's really just a matter of degree how much each has sold off. SHY has lost least, just under 5%, but because all of these are negative, none of them will be included in our portfolio. So you can see that amongst bond funds over the last 180 days, everything has sold off. And really, as yet, there's no sign of a stabilization in the bond space. So over the last 180 days, it's been utterly brutal in markets, such that only 3 of the 5 groups of funds have positive momentum. Bonds are out, factors are out, and at the country level, we've got MSCI Indonesia, and then we've got 2 energy choices. One for a pure commodity play, that's DBE, and another one is the energy sector, so that's XLE. Now, don't forget our offer from Stockcard. You get a 10% discount for your VIP subscription if you use the promo code PensionCraft, the name of our channel. And there'll be a link to that in the description of the video. And as always, thank you for listening.